The big story. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Benchmark crude prices have kicked off the year with an unexpected boost fueled by speculation that President-elect Donald Trump will intensify oil sanctions on Iran. This comes alongside President Biden's increased sanctions on Russian tankers, contributing to higher oil prices at the start of the year. Now, does this now set the tone for how oil prices will fare for the rest of the year? What are some investment strategies traders can consider to mitigate higher volatility in oil markets? Well, to find out more, joining me now is Mukesh Sahdev, who is the global head of commodity markets of oil at Rystad Energy. Mukesh, welcome to the show.
Thank you.
Good to have you on. Mukesh, for some context here, how have oil prices fared in 2024? What are some of the key themes that moved prices in the past year?
Excellent question. And I think you touched upon very eloquently that since Christmas, the oil prices are in a quite a good rise up and a rally. And a lot of people were focused on it being a Trump-driven rally, but I think I call it the last Biden trade because everybody was focused on Trump putting sanctions on Iran. I think Biden decided to create some more volatility and some news which was not expected. And I think these Russian sanctions are quite wide-ranging, quite sweeping. And also we believe that they have the ability to impact almost more than 1 million barrels of crude and product exports, which is a big number for oil markets to think. So that's why the oil rally we are seeing now. The only other consideration I would add into that is 2024, I call it, is a turning point year.
Okay.
And what it means is that how the OPEC really changed its strategy to manage the market. And in my view, did a very commendable job in providing stability, given it was a 70 elections year, given the huge geopolitical conflict. But still, the oil price stayed around the 75 and the 80s. So a stable oil price year by OPEC 2025 will be different. And I think I call it a tipping point, but I can talk more about it.
All right. You call it a tipping point. Tell us more. Why do you call it the tipping point? Does that mean you see prices to continue to rise up, or will prices peak this year?
I would say that the market management, which OPEC started last year, we all know demand, right? We were recovering from COVID pandemic, and everybody was hoping for China to do something magical, stimulus, and hope was built up, right? Now there is certainty. The one certainty is that Trump 2.0 is in place. The second certainty, which I think the market has understood, that China is also not going the big way. On an average, China's oil demand used to grow by almost 500,000 barrels per day. Now we have been looking this year and next year, the numbers in only 100.1 or 0.2. So the numbers are really down. So that's another certainty. So that's why I call that now 2025, I think the oil markets have understood Trump is in place and China is also not going to show. And that's why the market management, which OPEC is caught between the Trump, I call it Trump 2.0, and we also call it China 3.0. And in some ways, we have coined a word called OPEC 4.0, right? These are numbers just to make it easier. But what it means is that OPEC Plus as a group will be following not just a crude market management strategy, but they have become very strong as product exporters in the world. And Middle East has become, I would say, the new U.S. Gulf Coast of refining. And that is what is kind of the tipping point, and that it's not a price war game this year. This is going to be a refinery margins game.
I see. So with, Trump 2.0 and China 3.0 and OPEC plus 4.0, could we see more volatility in oil markets in the year ahead?
Absolutely. And I think what I would also add is that the energy transition was progressing at a certain speed in the past, and there was a lot of impetus to accelerate that energy transition. And a lot of the countries were progressing. We have seen a lot of big U-turns. We have seen big companies make changes as well. And those changes are now disrupting a lot of the processes. So the future view of the world, people are divided. OPEC and some countries believe the oil demand will be very strong in 2030s and 40s. Some people believe the oil demand would be very low. this divergence of future is causing disruption today. So, in some ways, I call it diversion ahead, disruption now. And that's what will fuel volatility. Another aspect is that 2025, everybody hopes and thinks would be a year of where a lot of the geopolitical conflicts will resolve. But we have already seen with Syria, we have seen South Korea, new, which were not unexpected geopolitical conflicts are arising. So those will also continue to add volatility, and it will boil down to ultimately how OPEC as a group of producer of crude and products will manage the market. And probably I can talk a little bit more about what I meant by OPEC 4.0 a little later.
I see. Well, are there any significant or perhaps underpriced risks to crude oil prices at the moment?
Here's what I would say, that we are not going into 90s. There are a lot of people who are calling for OPEC Plus to engage in a price war, and then that's the only way to put a brake on some of the non-OPEC producers, which is US, Brazil, Norway, Guyana, which are producing. And our estimates indicate that 2025, they will produce about 1.7 million barrels more than last year. The demand growth for 2025 is expected to grow by 1 million barrels. So if OPEC does not increase anything, we are overflowing in crude, right? And there has to be a different way to manage the non-OPEC pressure. And what we believe is it's not the price war. It's not take the price to 40s or 30s to kill non-OPEC. Our view is that OPEC will actually use the margin game. They will pump a lot of products into the countries like Europe, which are buying the crude from non-OPEC. So non-OPEC producers may be sanctioning projects and get ready to produce. But if OPEC Plus is smart enough and can go into those countries and push products, their demand for crude for non-OPEC will fall down, and that will put a back pressure on the non-OPEC. And that's, I believe, is something less understood, less tracked, and I would say is a little bit unpriced at the time as we speak.
I see. Well, in the high stakes world of oil trading here, where market swings can amplify tenfold, should investors then continue to be cautious of seismic shifts that it can occur at any time?
Well, I said, of course, investors need to factor in that the one thing which is very important, energy transition is not balanced. In the past, when population grows, GDP grows, oil demand grows, and everything we need more. The future ahead is we don't need everything more. We need something a lot less, which is as EV penetration takes place, we need less petrol, less transportation fuels. But we need a lots and lots of petrochemicals. We don't have electric planes, so we need the jet fuel. We don't have electric ships, we still need the fuel oils. A Tesla would also still drive on a road made from bitumen, right? So we need some part of the oil barrel more, and we need some part of the oil barrel less. This is where I believe the investors and people need to focus on which part we need more and what will drive that more. One example I can give you is that the world ahead, we need more petrochemicals, more plastics. So what kind of a crude delivers more petrochemicals, more plastics? It's not the heavier crudes in the world. And that's why probably Saudi Arabia canceled a big 1 million barrels per day of heavy crude oil project. So the world might be future towards more lighter barrels. So if you understand the skewed dynamics of how the energy demand in the future will be balanced by different cuts of the barrel, I think investors pay attention to that and don't treat it as, like tide lift all boats. The future tide will not lift all boats. And if you can differentiate, I think some good investor strategies certainly can be made.
I see. Now, let's dive in deeper into the key themes that could move oil markets this year. Geopolitical tensions, they've always impacted oil prices. So, Mukesh, could a further escalation in Middle East tensions drive prices up further, or have markets fully priced in potential escalations, you think?
I think there is a geopolitical fatigue in oil markets, right? They don't react these days as they used to react in the past, right? That's number one point. The second point is, I think it's fairly understood that there is an ample spare capacity because of the COVID dent, energy transition dent on the oil demand side. The Middle Eastern producers particularly have to make a lot of cuts. That has generated that there is a spare capacity available. So if any big disruption happens in the Middle East or somewhere else, the world has the barrels. It's not that we can't produce those barrels. So that spare capacity provides a bit of a check on prices escalating. The second point I would make, which is more interesting, is that there is a lot of talk around Middle Eastern producers wanting to take oil prices to 90s or $100s per barrel because they can't balance their fiscal budgets. Our view and our Rystad Energy, we do a lot of deep data analysis, and what that informs us is that they probably don't want a higher oil price because higher oil price leads to more non-compliance, leads to more leakage, leads to more cheating, leads to, more oil flows, even if it is not counted.
Right.
So a higher oil price actually hurts OPEC. So from that perspective, I would say the geopolitical tensions would still be there. OPEC Plus as a group is strong. It has the spare capacity. It has what I call two pedals to manage the market, a crude pedal and a products pedal. In the past, they were operating only with a crude pedal, either cut crude or bring crude. Now they have found out that it's not just a crude market. They pump products into the market, which is a different way of giving crude back to the market. So I would say they have a lot of multiple, let's say, ways to stabilize the oil prices where they want. And I don't foresee 90s. I don't foresee 60s. I think hang in this $75, $80 sweet spot and the volatile market will be there. That's how I still see 2025. Of course, what we cannot predict is suddenly Iran sanctions, these Russia sanctions, right? These will have few days of volatility one way or the other, but the market will return again into the stability because that's what OPEC wants and that's what they can deliver on.
I see. Well, speaking of OPEC Plus, OPEC Plus pumps about half the world's oil, and they've been planning to start unwinding cuts from October 2024, but a slowdown in global demand and rising output elsewhere forced it to postpone the plans on several occasions. So what does this mean for the oil market now?
I think what it means for the oil markets is fundamentally we are living in an oversupplied world. What do I mean by that? If there was no COVID, if there was no Ukraine crisis, if there was no energy transition, and the rate of demand growth, which was from 2015 to 2018, which is about 1.5 million barrels per day, if the world had kept on growing linearly in 2024, where we are versus that point, there is a gap of about 4 to 5 million barrels of oil demand. So fundamentally, the world has changed. It consumes less oil demand. And the reasons are primarily because, not just the EV penetration, because fuel efficiency has become a big part of the equation and the demand has reduced. Second, EVs and LNG trucks, which are replacing transportation fuels, are also there, part of the game. Plus, the hybrid working, the ways of working, work from home has changed. So fundamentally, we live in a world where we are still doing everything, growing population and everything, but we need less oil demand and we have an oil supply higher solution. So for going forward 2025, I think supply correction in the world is going to be the norm for oil markets. And what the traders, what the investors and people who play the game need to understand how this oil supply, oversupply will resolve. There are many, many pathways to resolve this. Of course, as I mentioned, one big pathway is OPEC Plus putting a pressure in an indirect way on the non-OPEC producers. So reduce supply, then the market balance. We are also living in a world where the strategic petroleum reserves in the world are empty. Like US has lost a huge amount of their reserves. You can fill those reserves and take this excess supply and put into the tanks and storage systems. That's one other way the world could resolve. Right. The third way I would say is that some stimulus in demand may shift, but we believe don't bank on demand hope. I think bank on and understand the supply correction sort of pathways. That's where the trading strategies or ideas will emerge. So 2025 tipping point is, it's not just crude market, it's the product market. It's not just the price war, it's the margin war. That's where, a lot of the devil is in the detail, as we say. So I would say trade with deep data-based thinking versus a more tweet-based trade.
I see. Well, some experts say due to this delay by OPEC Plus, the oil market will now shift focus to the actions of U.S. President-elect Donald Trump, who could impose new sanctions on Iran, tariffs on China, and has pledged an end to the war in Ukraine. How will more sanctions impact the oil market here then? And which of Trump's proposed tariffs will you be closely watching?
Excellent question. I think you're right. We live in a world where cuts, caps, quotas, sanctions, tariffs, right? That's what defining the oil markets, and not just oil markets, I think broader economic markets. We believe that the sanctions do not work, as we have seen. Iran is not the Iran of 2018 or in the past, where Iran was sending its crude to almost 5-6 different destinations. So if you want to put a sanction on it, you can easily. But now Iran is very much tied with China, for example. And China probably may not easily get along. China will negotiate itself with the U.S. So sanctioning Iran today is not the same as sanctioning Iran in the past. So it will not generate the same impact. Number one. Number two point I would want to add into this equation is that Trump, we were talking and discussing, what is a check on Trump policies? And I think the answer I get is the check on Trump is Trump itself, right? So Trump will trump in some ways itself, its own policies, and there will be contradictions, like you cannot do huge tax cut, and on one hand you can put huge restrictions. Both don't go hand in hand. So my and our analysis indicate this sanctions-based approach probably is not going to work. I think there will be more broader negotiations, and Trump also understands that as we go into the summer of 2025, he will not want a market which is pricing oil and gasoline pump prices are very high. Trump is in a unique position with Senate, with House under control. Midterm elections, if you lose a Senate or a House, then the presidency would again become a little bit restricted, and he may not be achieve the goals which is promising. So keeping oil prices stable, low, sanctions will only do the opposite. So our view is that there will be negotiated outcomes. We don't believe the sanctions will work, and I think U.S. probably understands. Yes, rhetoric will be different than the talk, and that's what Trump 2.0 would mostly look like.
I see. And I also want to talk about China here for a brief second. I mean, predicting future demand in China is, a complex puzzle fraught with rapidly evolving variables. Its aggressive pivot toward electric vehicles, expansive high-speed rail developments, and growing fleet of LNG-powered trucks are reshaping its energy landscape. So will China's declining demand have a huge impact on oil prices?
Yes, we used to say if China sneezes, the oil market goes for a big, still spin. I think the things are changing now, and the fundamental data has the answers. So I would say we need to look at China 1, 2, 3, as I was mentioning. China 1 is, if China never integrated in the global trade market and only grew by domestic demand, China's oil demand today would be somewhere around 7 to 8 million barrels per day. We know that China's oil demand is somewhere around 16 million barrels per day, near that. This extra is all driven by what I call China 2.0, where China became the factory of the world, and the call on China was huge. Now, China 3.0, going future, is not the same. I think China has decided not to make the toys and the socks for the rest of the world, probably high grade to high tech, more renewables, more tech kind of industry and sectors, and transition faster towards the EV because China has the coal. And I would say China has consumed huge amount of coal this year to generate electricity to drive the electric cars, which is a very smart way of driving energy transition, which Europe cannot do, which US cannot do. So we believe that China's only thing that will grow in China is petrochemical demand. the fuel oil demand growth will offset. So China's overall demand growth numbers will be flat, maybe 100 kbd, 200 kbd at max. And in that way, this brings us quite a big shift on the crude oil which China wants to buy from rest of the world. So again, it backed down to OPEC has to do something, and OPEC has to put a pressure on the non-OPEC side of the market, and then they have to find new ways and methods. So despite China's weakness, we believe we are not calling for 40s or 60s or 50s or that kind of a price range.
I see. Well, given all these circumstances that we've discussed so far, Mukesh, how should investors go about investing in the oil market? Are there any strategies that they can consider for higher returns?
Good question. Tough one, because what I call is a very regional. So I can give some pointers, right? Number one pointer. Globally, we have spare. Locally, we have scarce. So I call it global spares, local scarce.
Yep.
What it means is that we have enough oil in the world. We have enough, everything we have enough, but we have a lot of local scares. And these scares get caused by Red Sea crisis, for example. If Trump takes Panama Canal from China, again, chokeage. Strait of Malacca, Malaysia can be a big choke point. So pay attention to these, choke points and what flows in and out and how these flows can be disruptive. So that's where, globally things may look okay. Don't go by the global macro numbers and everything looks good. Go by the regional, tensions in the system. That's one point to sort of understand. The second point, I would say, if you really want to understand and trade the oil markets, it's not just a volume game, it's a quality game. And what's happening in the world is that, unfortunately, or whatever you may call, U.S. system refining is very complex. It was designed to process the heavy crudes from Canada, from Latin America, and also the medium heavy barrels and sour barrels from the Middle East. But lo and behold, U.S. found the crude below its ground, and I lived in Texas for 7 years in Houston, and I know that they found the wrong crude. It is a very light, sweet barrel. So in some ways, I would say the quality game is very important. Argentina, which produces U.S.-like barrels, light barrels, is also growing. So there is too much of a light, sweet barrels floating around in the world, and restriction on the medium sour barrels. And this is where OPEC also plays their crude quality strength. The world refining system, because the petrochemical demand is not growing strong, needs less light sweet barrels and need more barrels, medium sour barrels, which is in the OPEC hands. So don't just do the volume math, do the quality math. That would be my sort of a second point to talk. And lastly, I would say that especially the geopolitical driven data, driven numbers, and there is a lot of reactionary news which happens because now the trading in the world, in the derivatives, in the financial players market, algorithmic trading, quant trading has become a huge part of the whole equation and the business. So those players will react to small news very fast. And I think staying with the fundamentals, I would say, I'm a fundamentals person. We do fundamentals analysis. Staying with the fundamentals is probably the right thing to do. Yes, once in a while, you can be speculative and ignore the fundamentals. But if you want to really build a good trading, investing portfolio, don't fall for, just trading along with the trend. I think do some deeper fundamental analysis. I think you can find very good strategies there.
I see. Well, thank you so much, Mukesh, for your time and your insights today.
No, thank you. It's a pleasure, and thanks for having me.
Thank you. That was Mukesh Sahdev, who is the global head of commodities market of oil at Rystad Energy. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.